This is the 12th lecture in the series. It's recorded to replace the lecture that we're missing on Friday, the 14th of October, because of the open days. In the last lecture, we finished off talking about the role of regulation. Now, the reason regulation matters in macroeconomics, and the reason that it's clearly been shown to be important, is because credit creates its own reversal. We've seen in lectures that credit, in particular the production of credit by fractional reserve banking, is unstable. What this means is when you don't get paid back, the system has a tendency to collapse. Thus, regulation of credit is vital to increase the system's efficiency because it limits the potential for explosive and implosive banking collapses. Clearly, Ireland's regulatory climate in the pre-bust years was a great example of how lax regulation can lead immediately to the destruction of billions of euros worth of wealth in the present and the future. So regulation should be protecting all parties in the transactions that banks take place, that the banks use. So banks, borrowers, taxpayers and the government, and it should increase transparency and accountability, but in practice it doesn't actually have to. Sometimes regulation can act as a sort of a force field of bureaucracy and tedium. Now there are three types of regulation. The first is the stuff that you're probably used to, which would be the micro regulation, saying things like to an individual bank, you must have 8% of your tier 1 capital on your books at any one time in risk-weighted assets. Another type is the sort of what might be called mesoprudential regulation. So this is the idea that as a collective, the banking sector needs to be monitored, and needs to be monitored by the central bank or the financial regulator. The third option is macroprudential regulation, where you look at the entire system as a whole and including the real and financial parts of the economy, and try to see where the financial intermediaries, but also the individual borrowers and lenders are taking risk, and where eventually we might see things blowing up. So those are the three levels. Now, moving on from yesterday, we see the central bank's balance sheet. Now, the central bank, when I say the central bank, I mean an archetypal central bank, has two sets of assets and liabilities. And again, you can think about assets as sort of a positive amount here, and liabilities as negative, or sources and uses of funds, that kind of thing. Uses and sources, rather. We have government securities and then discount loans. So they can get the discount loans from the ECB normally. This is quite possible. They can get the discount loans there, and of course their reserves come from deposits. Yeah, so the government securities it can hold. This is a big deal if you happen to be in Italy, for example. It's a very big deal if you are a bank and you're holding Italian debt. Sorry, I'm again writing this with a mouse. If you're a bank and you happen to hold Italian debt, then you can get yourself into a bit of trouble. Now, the currency in circulation for the central bank, because they print this, okay? They print this, so this is a bit like its net worth, actually. At the end of the day, the central bank can always just print more money as long as it's credible, so this amount can fluctuate up or down as required, and that's very important. It's very important to remember, as long as it has credibility. And of course its reserves, it can hold gold or assets or anything like that as it needs to. Now, when we think about our central bank, we have the European Central Bank and we have the Central Bank of Ireland. The European Central Bank is one institution in Frankfurt in Germany. There's also the ECSB, the ESCB, the European System of Central Banks, and which is a net of central banks around Europe, and the Irish Central Bank is one of those banks. Okay. Now, the European Central Bank we're going to take as a proxy for the central bank. In practice, these are two different things, the net and the actual central bank, but for the moment we'll just assume we've got one big central bank. Now, the ECB purchases securities, and the ones it issues itself in fairness, from private banks, but also from the public, and it makes discount loans in three different areas in practice, but again we're going to keep it simple here, it makes discount loans to private banks that are repaid at what's called the discount rate. So the ECB can print money, but it can also exchange bonds for printed money using what are called open market operations, and it can also lend money directly to private banks on what's called the interbank market and the repo markets. But let's just assume that the ECB can influence the supply of money and also the nominal interest rate, depending on the conditions in which it's in. Liabilities of the bank, currency in circulation, and the reserves in their own vaults or in others. Now, we saw the balance sheet of the firm, we saw the balance sheets of the household, and now we've seen the balance sheets of the central bank. You put it all together and you get a national income matrix, which looks a bit like this. Now, going through it carefully, we have our four sectors, if you like. Just for simplicity, we're suppressing the central bank from this description just for the moment, just to give you a sense of what's going on in the model, or not in the model, but in the balance sheet. And then we'll add in the central bank later on, just so that it makes sense. So here we have our households. That's the household sector. Here we have businesses and they have two accounts: their current account and their capital account. And obviously we've got the government. Now notice that the rows sum to 0 and the columns sum to 0 in two places, but they are non-zero here, here, and here. This is very important. These are the activities of these sectors. So, for example, households have some consumption, which they take, this is a minus, from businesses. So you can see the households consuming, let's say, €100 of a good in a particular year, and that comes from there. So it's minus 100 plus 100, totaling to 0. Similarly, government expenditure, they spend their money on the businesses, plus G, and the money comes from the government, minus G. Investment comes from the capital account of the comes from the current account to the capital account, and this is a memo item. Very importantly, GDP, in a world where there's no exports and imports and no central bank, GDP is just C plus G plus I. On the other side of this, we have something you probably haven't seen before, which are wages, profits, and taxes. So you can think about this as sort of the uses of these funds, and here's another way to think about it: the expenditure. So households are paid some wage bill plus WB from the businesses minus WB, and of course the sums to 0. Businesses also pay profits as dividends to some households, plus F and minus F. And the households themselves pay taxes, minus T and plus T. Now we could very easily allow the businesses to pay taxes here, no problem, and that would just increase this amount, but it keeps it nice and simple. You can see right away what we've got is a situation where the system is consistent into itself, and you can see the flows of money within the system, but you can also see the stocks. So this is a very interesting and very good way to look at the textbook model of the macroeconomy that we have been developing over the last 6 weeks. When you sum the amount of consumption, the wage bill, the profits, and the taxes net of transfers, you get the total saving from households. Now, this can be positive and negative, but we'll assume that it's positive for the moment. So let's say your wage bill is 100, you consume 50, that leaves 50 left. You get 10 in profits, that leaves 60, and then you pay 30 in taxes. So this amount here, for example, would be 30. Okay, so you're saving 30. So just saving 30. For example, if this is 100, just reading down the column now, this is 100 minus, sorry, no, it's not 100, it's, what did I say, 50? Minus 50, and this is plus 100 here, and this is plus 10. What did I say about taxes? 30, right? Minus 30. Okay, so it's 110 minus 80, and so we have saving of plus 30 in this column. Okay. Similarly, this will all sum to 0, so the amount of, in businesses, the amount of consumption, government expenditure, and investment will be balanced by the amount of the wage bill minus the profits, because all profits are returned to the to the households. And this capital will balance here. Oh, sorry, it won't balance, but we'll have a certain amount of investment. Now, importantly, in macroeconomic equilibrium, as you saw from last year, savings equals investment. Okay, so we can make this thing balance, the entire balance, by just adding 30 here. But we don't need to. We can. Let's put a star there. We don't actually need to, but we can. And here we can see the government's expenditure is really the amount that it raises in taxation T minus G. And we've gone over the government surplus and deficit many times. This can obviously be positive or negative, but very importantly, it has to sum to zero. This is vital. This is vital. We have three balances here: saving, investment, and government services. Now, in macroeconomic equilibrium, of course, the government surplus is equal to its deficit. Or sorry, there is no deficit. There is no surplus. G is equal to T, so this is 0. Okay, and S is equal to I, so these two things balance. Now, let's say they don't. If they don't, if there's an excess of investment or an excess of saving, then this is going to appear here in the government surplus or deficit. Okay, and they all must sum to 0 over time. So it's a really nice way to think about this three balance idea, which has been, I can show you in later lectures, and it's a really nice way to think about the economy. But we can have an even more comprehensive description here. This is from Lance Taylor's really excellent book, Maynard's Revenge. Here's a balance sheet description of the entire economy as it exists today. So we have households up here in the top left hand corner, which every entity here has assets and liabilities. Obviously, households can hold money, bonds, equity, and tangible capital, which we'll just call housing. Their liabilities, obviously, their mortgages and their net worth here, but they can have other liabilities as well. Firms have assets, they're basically just their capital, and here in liabilities, their loans, their bonds, their equity, and their net worth. Government, importantly, the government very importantly has faith and credit as its asset. I can't emphasize this enough. What we have here is credibility. Yeah, if a government has credibility, it can borrow an infinite amount of money as long as somebody's willing to give it to it. Okay. If the government doesn't have that, then it can't borrow anything. It basically collapses. On its liability side, you can have its bonds. I'll show you a much more descriptive version of the government of Ireland, or the nation of Ireland's balance sheet in a moment. The central bank here has assets and liabilities, its bonds, its international reserves, and then its bank reserves as its liabilities. Commercial banks have loans, mortgages, things like that, and their bank reserves. They have money, the money that they have in circulation, and their equity as their liabilities, because they have to pay that back. These things are called special purpose vehicles, SPVs. They didn't exist 40 years ago. They really do now. In Ireland, we can think about SPVs. The best SPV we have is NAMA. It exists as part of an SPV. Its assets are mortgages and other stuff. Liabilities are what are called credit CDOs. Here we have something very interesting called leveraged finance. They have CDOs, they have repurchase contracts called repo loans, and on the liabilities, loans, repos, and equities. This is pure finance here. Absolutely pure finance. It's got nothing to do with the real economy per se. This is just rich people moving their money around to make a bit more money. But this is a real and important feature in Ireland. It's very important to understand this. Basically, this is the IFSC. Okay, that's what the IFSC does. It allows leverage finance to exist. It also allows SPVs and commercial banks to exist as well. And then for an individual country, we always have to consider the rest of the world. But in particular in Ireland, we need to consider the rest of the world because we're so very small. The liabilities really are the international reserves, or the net worth of the rest of the world, if you like. And you can make this figure as complicated as you like, but this is a nice description of the world in a certain sense as it exists today. This, as promised, is the balance sheet of Ireland. So here are Ireland's assets and its liabilities at the end of 2010. This is from the National Treasury Management Agency, the NTMA. Starting on the assets, on column A, we have 16.2 billion in cash. The non-bank National Pension Reserve Fund is 15 billion. Non-bank financial assets are 31.2 billion. And the National Pension Reserve Fund investment in our banks, 9.4 million. You add those total financial assets up, this one and this one, C and D, you get 9.4. the total loan assets of NAMA, this is very important. The loan assets of NAMA are actually kept away, if you like, from the balance sheet of the country. So they're treated as national debt, but they're not really national debt in a certain sense because of this SPV thing. Everyone assumes that the taxpayer is going to pay it off, but the SPV kind of keeps it off the balance sheets. Liabilities, we've got government securities and borrowings, 116 billion at the end of last year. These are the promissory notes to Anglo-Irish Bank for 25 billion, 5.3 billion to Irish Nationwide, and 300 million to EBS. The question is, do we pay that stuff back or not? It's 31 billion or so from these three columns. Are we actually going to pay these things back ever? I don't know. I'm not sure. And I don't think anybody else is either. Point G, special investment shares. These are, again, more finance jiggery-pokery to keep the banks alive. And our general government deficit, GGG, is just E plus F plus G, these three things. And that's 148.1 billion at the end of 2010. Our GDP was about 150 billion at the end of 2010, or 160 billion rather. So we're crawling up on 90 to 100% of debt to GDP. And again, on this other side, the assets and liabilities, the bonds issued by NAMA. So the two sides balance. Now, importantly, we can look at the components of the macroeconomy and how they change over time. Here's the national income matrix that you saw before, but there's no reason for all of these things to balance all of the time. In fact, at any individual moment, they're not going to be balancing. There's going to be stocks, there's going to be buffers, there are going to be sales not realized, invoices sent but not paid, and things like that. So there's no reason for everything to balance. It only needs to balance in our theory, if you like. But you can see that there's also a very nice description of supply and demand here. So to give you a sense, here you have households demanding, CD, and you have businesses supplying. So we'll go through this in a second once I show you the components in this system. So here we have C, G, I, and so forth. And in a moment I'm going to show you the real data for that. So what you're looking at here is this is the percentage change from a year ago in 2005. So this is the amount of consumption that we have in the economy, 6.9 billion. It increased by 6.9%. In 2006, consumption increased by 6.7%. In 2007, it increased by 6.4%. 2008, the wheels fall off the bus a little bit, minus 1.5%. And 2009, minus 7%. This is the average over the 4 or 5 years. This is government expenditure from 2005, an increase by 3.9%, by 5% in 2006, 2007 still increasing, and then in 2008, the wheels kind of fall off the bus a little bit, minus 4.4%. This is the moment that Brian Lenihan stands up in the door and says, we have turned the corner. I don't feel like I've turned a corner, I'll be honest with you folks. So investment increased by 15% in 2005. I still feel like it should be a typo, but it's not. 2006 increased by 4.6%, 2.8 in 2007, minus 14.3 in 2008, and minus 31% in 2009. Huge increase. Exports stayed pretty constant throughout the boom, and then fall off obviously as the boom levels deteriorate, and imports obviously keep it pretty high, but then decrease. The GDP, which is the sum of C plus G plus I plus X minus M, increases by 6 and 5.3, 5.5, and then decreases by 3.5% in 2008, and then decreases by 7.6% in 2009. The value of GDP is 162 billion in 2005, but only 160 billion, 159 billion by the end of 2009. Now recall that our total general debt is 148 billion plus 30. Okay, so it's really quite an amount. So that's 170 billion if you add in the NAMA stuff, and this is 160 billion here. GNP, which is just GDP minus net factor income from abroad, as you'll remember from last year, is plus depreciation, is minus 11% nearly in 2009. So really quite a lot. And you can see the discrepancy here in 2009, for example, between GDP and GNP. It's 160 billion versus 130 billion. There's a 30 billion euro difference here. It's really quite considerable. Okay. So I promised that we'd show you the flows between the elements a little bit, and we can do that. So the flows between the sectors, and at the end of any year or any period, we can assume that they balance by a supply and demand correspondent, where the amount supplied is equal to the amount demanded, exactly in the textbook kind of supply and demand way. But you need a story to work this stuff out, right? So you need to be able to say, well, look, how does it work? It could work by Walras's law. This is the law named after Leon Walras, which essentially says that when all markets are in supply and demand, the last market must be in supply and demand equilibrium. In other words, there should be a general equilibrium working itself out through the price mechanism. Second thing to talk about is rationing theory. So the idea is that basically at any point in time, if supply and demand aren't equal, it's because the market is short somewhere. Either there aren't enough demanders or there aren't enough suppliers. And the reason that there aren't enough demanders or suppliers is because prices aren't changing fast enough. There's some evidence to support this idea, but the idea simply is the constraint, whatever the constraint is controlling the price. For example, if you want to sell a house right now, you can't really, or you're going to have trouble selling it, not because there's any lack of supply, but just because there's a huge lack of demand. And if prices adjusted down fast enough, so the rationing theory goes, you would be able to clear the housing market off. Inventory management. Firms do and will hold a buffer of fixed goods. So this can help equalize supply and demand. So when demand is up, you could just eat into the buffer, and when demand is down, you can just add to the buffer. So at all times, supply will equal demand, and effective supply will equal effective demand. But you'll need to consider the buffers. And then the simple Keynesian quantity adjustment, rather than prices, and prices being sticky, the idea is that Keynesian quantity adjustment works to make sure that the quantity supplied equals the quantity demanded if their prices aren't actually fixed. So let's consider this in terms of flows. Here we have the amount supplied, the amount demanded in consumption goods. Here we have the amount of government expenditure supplied and the amount demanded by the government. Here the amount of investment supplied and demanded by the capital markets, if you like, or for productive investment. The wage bill supplied and demanded, profits supplied and demanded, and taxes supplied and taxes demanded. So you can see here these are the flows within the matrix, and we use the subscripts D and S to kind of convey that message. Okay, what does this imply? It needs to balance we need to balance the balance sheet after each period. Everything goes somewhere, and we count the stocks at the end of the period. This is kind of vital for stock flow consistency. It's very important when we're measuring the economy. And we measure the economy measuring the C plus I plus G plus X minus M, as I've shown you just there. And we use it. We do it using this balance sheet method. So that's the end of this lecture. And just a reminder that we will have other lectures on November the 4th and 5th of next month. They will also be podcast in this way. Thank you very much.